Nnamdi Okike joins us today from New York City. He's the co-founder and managing partner at 645 Ventures, an early-stage VC firm investing in software and software-enabled startups. 645 has invested in companies including Resident, acquired for $1 billion, Iterable, Overtime, League Apps, Rent Spree, and Setpoint, amongst others. Prior to 645, Nnamdi spent 8 years at Insight Partners and invested in standout companies like Provalia and Mimecast, which were acquired for $600 million and $6 billion, respectively. Nnamdi, welcome to the show.
Thanks for having me. Really appreciate the opportunity. Great to be here.
It's a pleasure to have you on, sir. You guys have accomplished a lot. You've done a lot at 645. It's a very well-respected firm in the industry, so it's a pleasure to have you. Good place to start. Maybe some quick backstory on, your path to venture.
Yeah. No. Great question. Great way to start. So I first got interested in technology when I was in college. I didn't have any family background in it. My parents weren't in tech. Really, all I knew about tech at the time was, I liked tech products. I was kind of a early user of the internet and, but I didn't know anything about how tech companies worked or how they were financed. So when I was in college, it was kind of like the dot-com boom. So a long time ago, kind of like early days of the internet. And I had some friends who were like doing startups and starting companies. I was like, oh, that's really cool. Didn't know that was something you could do, and it kind of intrigued me. So I said, wow, I want to learn more about kind of how this all works. And so, I was at Harvard College undergrad and you couldn't take any classes at their business school. That was one of the rules, but you could cross-register it over at MIT B school, the Sloan School. Sure. And so I audited a couple classes, and one class was called New Enterprises. It's a pretty legendary class now. It's been taught maybe for 40 plus years. And it's a class that's, basically spurred or kind of catalyzed the formation of companies like HubSpot and a bunch of great tech companies in Boston. And so I took this class. It was taught by a couple of guys who were professors, adjunct professors, but their full-time job was they were VC, co-founded Battery Ventures, his name was Howard Anderson, and then the other professor, Todd Dagris, co-founded Spark later on. And so great guys to learn from. And at the time, I didn't even know what venture capital was, honestly. I was taking this class. I was like, what do you guys do? What's your background? What's your job exactly? And I was just really intrigued by it. I was like, wow, I didn't know this actually was a profession where you could invest in these companies and, play a role in helping them to grow. And they'd tell stories about their experiences backing founders. And for me, it was just fascinating. I said, wow, this is pretty interesting. This is really a whole new world. And so that's kind of how I first learned about venture. And then, I got a lucky break going to work for Insight Partners, which at the time was a pretty young fund. They were about 15 people. This was early 2002. And I joined them as an analyst. So I kind of lucked into it, I would say. It was kind of serendipitous, but learning about VC through taking this class and then getting a job as an analyst coming out of school were two kind of lucky breaks. But I was able to get into the industry early and, kind of build from there.
I saw that you have 3 degrees from Harvard, Nnamdi. Did you have any overlap with Mark or, other founders that were there in kind of the aughts?
Yes. Well, that's an interesting story and we could kind of spend time there, but long story short, so I didn't know Mark when I was in school, but the year after I graduated, Facebook got started a year and a half after, I should say. And when I was at Insight, I sourced that company. We didn't invest in it actually, but yeah, true story. So, at the time, a bunch of my friends were joining the network and I was tracking early stage companies, although Insight was a growth fund, and that was the reason we didn't end up investing. So long story short, I was tracking it. I joined the network in 2004, which was the first year. It was called the Facebook. And I remember going to the website and at the bottom of the website, it said a Mark Zuckerberg production. And that was pretty unique because when I was sourcing deals at Insight, most founders didn't do that. That was not on the website. You got to go find the founder, or maybe there was like a team page. And so I clicked on this link. It said a Mark Zuckerberg production, and it basically email popped up, Mark Zuckerberg. So I emailed him, and he replied, and he said, hey, thanks for the email. We're not raising money yet. We're going to be raising, I think he said in the next 6 to 12 months, but appreciate you reaching out and would be great to meet up in New York. And then the most interesting thing about it was, and this is a long story, but Eduardo Saverin applied to work at our firm as an analyst that same year.
No kidding. Wow.
And so long story short, we interviewed him. He didn't get the job. And the deal was too early for Insight. It was basically pre-revenue. It was pre-revenue consumer company, and that wasn't our mandate, so we didn't end up pursuing it. But short story was, it was something that, taught me a lot, both in terms of kind of how different these companies might look at the early stage. And also, I think being really young and being somebody that had just graduated, I think I had a sense that there was potential there, but it's really hard to articulate because it didn't have any revenue. It was just a bunch of people using the site. But long story short, so they were there when I was there. I think they were a couple years after me, a couple years younger. But yeah, there were some interesting folks starting companies at that time. Like Parker Conrad was my same year. He started obviously Rippling and Zenefit. So it's a bunch of interesting founders that were there at the time. Wish I had an angel fund at the time to be able to invest in those companies, but
I know, right?
It was too young for doing for that. Hadn't made any money.
It's funny because I saw a pitch from Larry and Sergey when I was in college.
Oh, wow.
And it was just, a little bit before your time. And so it was very early days of Google, but
that must be pretty interesting to see.
We had no idea at the time how big it might become.
That's crazy.
Quick lesson for the junior investors in the audience, Nnamdi. When you reach out to a founder and you think it's quite compelling, and they say, sorry, we're not raising 6 to 12 months, what would your advice be to those young professionals?
Oh, man, that's a great question. So there's a few pieces of advice I would have. I think the first is have courage of your conviction. If you really believe something's exciting, it might be the case that a deal that you're advocating for is a little bit outside the strike zone of the firm, or to your point, the founder may not be raising money. And I think it's a great time to build a relationship. So what I might have done in that case would have been to say, hey, that makes sense, but let's how can we help you? How can we provide help, resources to kind of get to know you, anything you need. And also really pin down the founder around what deal they might do. Cause usually, there's some flexibility there. A founder might say, hey, I'm not planning to raise for 6 to 12 months because of X and Y. But then you might say, hey, well, our mandate is X, or we're flexible. We might be able to put some money in ahead of that or what have you. So I think I would say, look, have the courage of your conviction, be really thoughtful, try to engage the founder as best you can. And that is not a hard no. Oftentimes it's maybe a soft no, and kind of think through, okay, what's driving that? Cause most founders I find are pragmatic, right? Especially in the early years of your company. Somebody might have said, hey, you should raise in 6 to 12 months because you'll have X revenue or traction or what have you. But, if you believe in it, you might have flexibility. So those are my learnings.
So Nnamdi, you had a great run at Insight. You're investing in some, notable companies.
Yeah.
You have a great platform underneath you.
Yeah.
And then you leave to start 645. Why did you leave to start your own firm?
Looking back on it, it's been over 10 years, almost 11 years now. I think a lot of the reasons remain pretty consistent, which I'm happy with, right? I like the fact that a lot of the insights that I had at the time and Aaron, my co-founder, had have really remained true and have really enabled our firm to grow. So I'll kind of describe them. So Insight was one of the pioneers of outbound sourcing, which is basically going to companies rather than having them come to you, and reaching out, like I described in the case of Facebook, reaching out to founders, based upon certain signals, right?
Yep.
Now, Insight, which folks may know, is now a multi-stage fund, but in their kind of first 10 years, they were really primarily a growth fund that looked for firms that were revenue generating, typically bootstrapped. Insight's history was in B2B software, still the majority of what they do. Over time, they expanded into other areas, internet, consumer internet, commerce, what have you. But their bread and butter is still software companies. And so the first decade of Insight basically was focused on bootstrapped software companies, kind of off the beaten path, right? And the sourcing model was a way to find those companies, typically way ahead of other firms, and really lead rounds in those businesses. And the best exits that Insight had, and really even now, are deals that kind of fit that profile, right? So as I spent time at Insight, I started to say, wow, this model is great. It's worked really well. It's enabled Insight to have wonderful returns, but the early stage is changing. And I saw this interesting dichotomy between what I saw Insight apply at the growth stage and what I saw early stage investors doing. And it was almost like day and night. Early stage guys were kind of pure gut feel, pure kind of network driven, very much I would say top heavy in terms of how firms work. So a lot of firms at the time, and even now at the early stage, are kind of partner only or partner primarily didn't really have junior teams, didn't really have a really resource intensive model. And I'd seen at Insight, they were one of the first firms to really build a platform. They called it Onsite, that really was kind of dedicated to helping companies and really serve founders and really help them grow their businesses. And I said, wow, there's this model that I've seen work really well at the growth stage that I think could be kind of tweaked, modified, but applied to the early stage in some interesting ways. And because I was seeing companies like Facebook and others that were growing dramatically fast early on, but didn't yet have revenues, didn't yet have a lot of things that Insight was looking for, I felt there was a bit of a opportunity to build a new kind of firm that leveraged software, advanced technology, that applied frameworks to early stage companies, and kind of found these diamonds in the rough and really systematized how that worked. And at the time, and even now, I think that was kind of a contrarian, non-consensus approach. When Aaron and I started working together and we started pitching investors, LPs, they said, hey, well, what signal are you going to go on if you're doing early stage? What are you tracking, right? They would say, early stage is typically a geographically constrained business where if you're a seed fund in New York, you do seed companies in New York, you don't do deals outside of that. Or if you're early stage in the Bay Area, you only invest there. You don't invest outside of that geography. And we were talking about a multi-geographic approach, using data and software, applying an outbound sourcing model, having a junior team. All those elements were pretty non-consensus. And I think that actually gave us some confidence that, hey, we might be onto something, because I had seen, again, like this model work to source these early stage companies, but Insight really wasn't well suited in terms of its fund size to do those deals. When I departed Insight, they were raising funds that were, $10 billion. And so doing a small check in a company at seed or even Series A, the response would be like, hey, not worth our time. That's kind of a rounding error on our fund. Like, why would we do that? Yeah. And so I felt that it would be better to have a fund and a firm really that were kind of dedicated toward that stage and really kind of had a process and system to do this type of deals. And so that's kind of where Aaron and I had a meeting in the minds. We said, look, we think this could work. Aaron was at the early stage. Aaron is a computer scientist. Aaron was talking a lot about how to use software and systems in a firm. And I had seen Insight be one of the first firms to have a database. And that was actually the bread and butter of what we used to source was our database. And we said, hey, how could we build a new type of software and database approach, but that was really well tuned toward the early stage, which is a different ballgame, in terms of what you look for. And I can kind of discuss that. So those are some of the reasons, I decided to depart. And, I think a lot of the folks at Insight said, wow, we're a big firm. We're doing really well. It's very lucrative. Like, do you really want to take that leap and do this? And, I felt, hey, it was a good time to do it. I felt there was an opportunity. We were willing to be scrappy. So that was kind of like the formational story.
So, Nnamdi, can you give us some examples of like the frameworks or the signals that can reveal some of the diamonds in the rough that you mentioned before?
Yeah. And I'll describe also how that evolved, right? Because there's been a lot of evolution. That's one of our core values at 645 is the idea of like, the firm is built to evolve. We talk a lot about kind of learning from the greats and then, kind of evolving the firm as we go. So I'll describe kind of like our initial hypotheses and then specific case studies and kind of how we learned to really apply this data-driven approach. So as I described coming out of Insight, I was very traction driven, right? When I would source, I would look for things like, growth in software downloads for downloadable software companies, because some of the best wins we had at Insight were kind of downloadable software companies. I would look for web traffic for consumer companies because that was a signal for some of the best consumer companies we had in Insight, like, companies like JD.com or Trivago. There's a bunch of big wins we had that were basically driven off, signals of web traffic and consumer traffic. I would look for things like ARR growth and, revenue retention and some of those things that, folks doing growth stage would look for. And that data kind of became what we call our analyst score that basically like assesses a company's traction. So you mentioned Resident as an exit we had. That was a business that was growing dramatically fast at the early stage. It went from a launch to 100 million of revenues in like 2 years, which is pretty crazy. Wow. We came into the Series A of that business. One of our venture partners, Andy Berman, first told us about it, and Aaron kind of led the due diligence on the deal. And we were so impressed by the growth. And it was a company in a category that was kind of out of favor. So what Resident basically provides today is different furniture, but primarily mattresses sold online. And at the time when we invested in the Resident, people had done Casper, they'd done Purple, and I think people felt, one, that the market was already won, primarily by Casper, and two, that was like, hey, is this really a good business model? Like, at the time, direct-to-consumer was going out of favor. And so when we did Resident, like, it was kind of a non-consensus bet. Like, they didn't really have, even when they exited at $1 billion, like, they didn't really have any big brand name VCs in that deal. I think because a lot of folks kind of looked past it, given the category, although it was growing, again, if you actually looked under the hood, dramatically quickly, and had really good marketing, return to marketing, great data that kind of like validated that was a good company. So that was an example of a company that kind of came out of this data-driven approach focused on traction. But what we also learned was that being able to assess founders and founder quality, as well as market quality, were really important. And I think that was one thing that I didn't fully appreciate coming out of Insight was, look, if you're doing a seed or even a Series A, you're not necessarily going to have like a lot of traction data points, especially for software companies in certain categories. You're going to have to look at other signals. And so we started to develop ways to assess founding teams from the outside looking in. And this is really for us what we call a prioritization mechanism. We believe great founders can have all kinds of backgrounds, come from all kinds of places. Sometimes, they're first-time founders. There's no background or no historical data to go on. But we did find that there were certain clues or signals. So I would mention a few. We invested in a company called Panther Labs, which is a security software company in our first fund, started by a founder named Jack Naglieri. Our software flagged Jack for two reasons. One was he was a security engineer at the time at Airbnb, which is, I think, about to go public at the time, and, was producing some really interesting founders. So, Coinbase came out of Airbnb, for example. But the second thing that was maybe more relevant was Jack had already started an open source project called StreamAlert, which basically was an early version of what Panther became. And so he had launched StreamAlert. It was starting to get adoption, and our software had flagged that. And so basically, we had some info to say, hey, Jack is maybe a high potential founder. Let's get to know him, reach out to him, got to know him, invested in his first round. And, the deal did very well for our first fund. And so we started to learn about ways to look at the full picture of the business in that early phase. And we have the ability to invest at different, we kind of describe them as different sub stages of early stage. So we primarily come in at seed. We can do pre-seed. We can do, growth seed, which is seed with traction. We can do Series A. And so we started to kind of create almost frameworks and models that were kind of like tailored toward each of those kind of sub stages. And really kind of like our aim was to have a holistic view of a business. So founder, market, traction, competition, all those different parameters. And we started to be able to say, look, there's data that we can kind of pull in using what we call our automated scoring. And then we have our analyst scoring. And that gives us a complete picture of a business. And we found that there was a lot of companies that were under the radar that model could kind of gin up. I'll give you another example. So I'm on the board of a company called Rentspree. Rentspree is a vertical SaaS company in the real estate market. They provide software for rentals. The company's in LA. When we first found Rentspree, they were generating about $2 million of revenue. Hadn't raised any venture money at the time. Had really been bootstrapped, raised a little bit of angel money, growing at a really nice clip. And they were kind of in LA, and no LA funds wanted to invest in that company. I still don't understand why, looking back on it. I think maybe it was the category. They were first-time founders. But when we started looking at the business, we were like, wow, these guys are growing pretty quickly. They've got a really good software product. They've got a long-term vision for the business. And then the thing that really intrigued us was the market. So in the case of Rentspree, they're providing software to, I describe it as the long tail of landlords, to basically streamline and improve the rental process. Everything from screening tenants at the time, providing other things like renters insurance. Now they have rent payments. So it was a part of the market that was really overlooked. Most folks focus on kind of large real estate, kind of very big.
Large multifamily
These guys are going after the other side with a really convincing, compelling kind of go-to-market model that was very capital efficient. So that was another example of kind of an under-the-radar company that was really, in our view, just overlooked. And I think it was primarily looking at the company's early traction combined with market that got us to really prioritize it. So those are a few case studies.
Do you have any advice for maybe founders in the audience or investors in the audience that are in a situation where they're entering a category that's been well covered? There are big players, and maybe they do have like an interesting, unique ICP, or maybe their go-to-market motion is unique, but they're running up against that headwind of like, there's pretty well-funded players and this category is well covered.
Yeah, that's a really good question. And I do think it's actually an area where VCs can do super well, because it's almost like you're a little bit contrarian. You're looking at a place where other folks don't believe, will yield high returns. I think that's actually a good place to play as a VC. But I'll describe maybe a couple ways to kind of get comfortable, and also as a founder, how you get VCs comfortable. So I think if you're a founder, you really have to describe why the world has changed, or why the preconceived notions are incorrect. And I think using data is the most compelling way. Not everybody's going to buy it, but I think it's the most objective way to do that. So if you take Rent-Spree, when we first looked at that company, Michael and Paul, the co-founders, said, hey, like, this is the data on rental properties in the US. And over 50% are what you might call like small landlord, like less than 10 units. We were like, wow, that's kind of interesting. We didn't know that. We weren't aware of that. We didn't come in per se with a lot of preconceived notions about that market because we really hadn't invested in the rentals category. But that was kind of compelling. The fact that like, hey, they're going after a part of the market that is the majority of the actual units. So the second question was, how do you get to them? Now, I think Michael and Paul were able to, in a compelling way, describe why some of the historical approaches hadn't been good. A lot of folks had been focused on going to them directly. So trying to market to your small landlord or your small realtor. What Paul and Michael said is, hey, we're going to go through a partner model. So instead of trying to go landlord by landlord, we're going to pursue partnerships. MLS systems, realtor organization. Now they have partnerships with a bunch of companies like apartments.com and all these big aggregators. And we're going to go partner driven. So we're going to have a lot more leverage in our go-to-market. And if we kind of play our cards right with these partnerships, they might bring us thousands or tens of thousands of landlords rather than, hundreds or tens. And so that was intriguing. It was kind of like a first principles approach. And so I find that as a founder, what you want to do is you can't put your head in the sand and say, hey, I'm just going to be oblivious to like what people think about my category. I think that's actually a failure mode. You have to speak to the concerns, regardless of whether they're legitimate or not. Sometimes people might have preconceived notions that are really the result of something that might have happened 10 years ago or 15 years ago. But I think as a founder, you want to be a student of the game. I think you want to understand what's happened because it, one, informs what you might do differently. And it also enables you to understand or really articulate the why now. And we find this a lot. Like you find oftentimes that like there'll be markets where there's been a lot of failures, but the why now might be really compelling. Right? It might be the case that the economics didn't make sense 5 years ago, but now they make sense for different reasons. Or it might be the case that, the technology was kind of crossing the chasm and, now it's ready for prime time. I think there's a lot of examples now of tech where that's the case. We could talk about it, but, there are certain areas where like, yeah, there's been a lot of failures, but the economics are fundamentally different, and this is the time to invest. So I think as a founder, you want to be able to articulate some of those elements. Like the why now, what's changed, what happened in the past, why might it be different? And then be very objective. And then as a VC, I think you want to have that level of objectivity. And I think one thing I find that's interesting is you might have naysayers within the firm who have some scar tissue, right? Yep. Who, with good reason, say, hey, we invested in this category and we lost money. Like, why is this going to be different? And I think like you have to be able to, in a compelling way, explain why it might be different, and then just have conviction. I think that's the last thing. Like, you're not going to know everything. You're going to have to take some level of risk, but that's what I've seen work. And I think it's a tremendous opportunity to make money as an investor because I've seen so many deals where the consensus was wrong, in terms of like what the category was perceived to be.
It's funny you mentioned that because I was speaking with, I don't want to name names, but I was speaking with one of the largest AngelList syndicate leaders recently. And we were talking through, and he said, basically he gets an allocation in anything that's led by like a top 10, top 20 tier 1 lead, right? And he's deploying like $100 million a year. I was like, wow. And I'm like, how has that been for LPs? And he said, not good. It's a terrible investment model for the LPs, but it's great for me. And I was like, wow, that is like the hazard of the industry right there. It's like you're just looking for signal from the lead investor, and the returns are not good.
Yeah, so interesting. It is interesting. It's an interesting topic, right? Like, if you think about like investing where great funds are investing, there's a few things that we think about. I think the first is even the best firms, they may have failure rates that are 40, 50% in their portfolio. So if you're investing with a great investor, doesn't mean you're getting into one of the best companies. The other thing is like, why do you have that opportunity, right? So like, if you're a great fund, usually those funds are quite greedy. And if there's a company they love, they're going to double down and do as much as they can, right? So if you're getting an allocation in a deal that's led by a top firm, you got to think about like, why is that? Sometimes it might be legitimate. Sometimes it might be the case that you're bringing somebody to the table or the founder really wants you in, but you just have to kind of think about that a little bit. I think the other thing we've learned is if you're leading rounds, you really want to think in a non-consensus way because, like it is the case that consensus companies can get big, right? There are some deals that were super hot from the get-go and they succeed and, people make a tremendous amount of money. There's a lot of examples of that, right? I would say Wiz is an example recently, right? Like if you look at every round that Wiz did, great investors in there from the get-go, and like that it's a founding team that had built a company, sold to Microsoft. Yeah, that's a consensus company and it was consensus for a reason, right? Great founders, big market, etc. But if you're a newer fund that's up and coming, it's unlikely that you're going to get into a deal like that unless you have a really compelling reason and a really compelling positioning. And so I think it's more likely that you're going to find something that is non-consensus that other people are not pursuing. And where you have some kind of proprietary understanding, I think it's more likely that's where you're going to really make your money. And so 100%. We think a lot about that. We think a lot about that as a firm. Like, how do we develop that understanding? How do we think differently? What are our advantages? We love to have great investors come into our deals, but we'd rather have them come in at the growth stage. When the company is 20 million, 30 million in revenue, is proven out, cool. They pay a great price versus like, we're coming in a seed or A and, it's just, it doesn't necessarily, and we've looked at our returns as well. And, like many deals where we came in alongside that big brand firm, early on didn't end up that well, so.
Well, you gave a really good example before with Resident, right? Well-covered category, like contrarian go-to-market approach, and there was money to be made there. Clearly, they've already exited.
Yeah, and there's a lot of examples. We have companies in our entire portfolio where we'll say, man, like we were there early. We kind of saw something. We should have had some courage of our convictions. I think that those are learnings, and I think now we very much believe that we do good work, we do good research, so we should be a prepared mind. We should know more than most folks and be able to make a smart decision. So we try to rely a lot more on our own intuition, our own work, rather than any third-party validation, whether it be how competitive the round was, et cetera.
A few minutes ago, you mentioned the database at Insight that kind of inspired your own. What's the overview or what's the difference between your early stage sourcing database and approach versus, the well-documented databases at the growth stage?
Yes. I'll describe that. I'll also describe like how we use the database and also how junior folks use the database, because I think that's the crux of it, is like, how do you use it for sourcing? And I'll also describe maybe the history of like databases within venture, because I think it's kind of interesting. So if you think about like using databases in venture, firms have been using databases now for maybe 20 plus years. Like when I started at Insight, we were using a Lotus Notes database. That kind of dates me a bit, but that's what we were doing, is Lotus Notes. And then it became Salesforce and it evolved, and but it was basically like going back there, like super dumb databases, right? Like basically you put the information in, there's not a lot of intelligence. It's solely a repository of information. It's not going to really do at the time any analytics. It's basically going to be a way for you to manually track. So you can say, okay, I talked to this company and it's 500K of revenue. It's got 5 customers or whatever, 10 customers. You write that down, put it in the database. These are the founders, this is their background. And then, 6 months, 12 months later, you call them up and say, hey, like, I remember we talked and you were doing X in revenue, and how big are you now? Or, how many customers or what have you? And you see those patterns and you start to triangulate kind of in a manual way. Now, at that time, that was even more advanced than what a lot of firms were doing, which is basically not using a database, like not tracking anything. You'd be surprised, like even now, like a lot of firms don't really systematically track their deal flow. And I think for that reason, you have a lot of companies that you just kind of meet once and you overlook and, never look back at again. And so what I saw at Insight was there was value in this kind of systematic tracking, although it was very manual. There was value in systematically tracking companies, writing down what you learned, using that to kind of start to see patterns, doing it across a lot of companies. And as Insight grew, a very big sourcing team. And then being able to triangulate, right? Being able to say, wow, we talked to 10 companies selling into a vertical and they're all kind of growing, like, maybe there's some tailwinds. Or we talked to 25 or 50 companies. We talked to a lot of them in certain areas, and this is clearly the best one, and this one we should invest in, right? So when we started 645, we said, okay, we've seen databases work. Let's build an intelligent database that could proactively surface insights rather than us having to manually extract them. So for example, could you have software that proactively showed you companies rather than just relying on you to put them in? That's something we call candidates. We refined that over time. So our software basically will show us companies, and we have a system now where we kind of go through those every month, and we have quotas for each team member. And I go through it, Aaron goes through it, everybody goes through it, and we review those companies. And sometimes our software will show us something great because we provide it with effectively algorithms that will kind of uses to flag companies. It might be a signal based upon the market. It might be a signal based upon the founder background. It might be a signal based upon traction, what have you. So we said, okay, how do you bring intelligence into a database? How do you help it? How do you help or enable the software to enable you to source better? Also to prioritize, to track businesses. Also, how can it inform your value add? So one thing that we have in our firm is what we call our success team. It's basically our platform. And we track all of our value add activities in our software. It kind of informs it's a really objective way for us to see how we're helping our companies, what areas we can be improving in, where we've led to customers that have joined, or, customer intros or hires or what have you. So we kind of systematize that, and we try to use software to keep us honest. The other thing that I would describe is, how do you train junior people to learn what's a great business? So one of the biggest challenges with a sourcing model leveraging a junior team, especially at the early stage, is how do you teach people what excellence looks like, right?
Judgment.
It's easier to do that at the growth stage, where you can say, look for companies that are, 5 million in revenues and growing 100% and, have this rule of 40 or whatever, right? You can kind of teach that somewhat reasonably and have people learn. But if you're trying to teach somebody this is what an exceptional company looks like at the seed or the Series A, it's harder, right? Because it may not have a lot to go on in terms of traction. And founder backgrounds can be kind of subjective, right?
And to your point before, sometimes the non-consensus things
are
the good ones. And how do you teach somebody to look for things that don't match the pattern?
So that's one of the biggest challenges, is to kind of blend this idea of using data to kind of narrow down the field with having an open mind. So what you find oftentimes is it's this interesting blend where there may be one area where there's a strong signal. So it might be hey, first time founding team, no real data to go on, but hey, the product launched and is growing dramatically fast. Or it might be hey, product not launched yet, but founding team that looks pretty exceptional based upon these qualities. Or it might be hey, I just think this market's great because I've spent a lot of time in analyzing, and I think the market is actually really exciting. And I'm just going to manually talk to a lot of founders to try to figure out who do I think is best positioned to pursue this, right? And that's a much more subjective analysis. You're kind of looking at the insights of the founder and maybe their first principles thinking, and that's a harder approach. We have created something we call founder paradigms. We're going to release a blog post soon around this. It's basically some of our learnings around founder quality. So we have things we call purity of motivation, which is basically the why behind why a founder is building a business. And it's really the deep kind of stimulus for the founder starting something. And that could be a personal purity of motivation. That could be a professional one. That could be caring about a problem deeply. We think a lot about that, and we try to assess, do we think that's there, right? We have other paradigms. There's one we call, it's not really proprietary to us. I think Andreessen might have created this first, but it's this idea of an earned secret, where a founder or a founding team has spent a lot of time understanding a problem and they've come up with some proprietary kind of earned learnings that most people wouldn't understand and that are oftentimes non-consensus. So we look for that. We try to define like, okay, is there an earned secret? What is it? Like, do we believe in that? Or are we like, do we think they're right? Especially if it's not consensus. So we have some of those paradigms that we use, and, we'll kind of tag founders based upon that. We'll say, hey, this founder scores really high on Pretty Motivation, and this is why, And so I think that's another way. So like, long story short, we use our database for a lot of reasons in a lot of use cases. We're always learning. We try to make sure that it's a way for us to get better and for us to learn. And so, we'll do things. We have something called after action review, AAR, which is basically a process that we can run. So say we miss a deal that gets really big and that's, exits for a lot of money or what have you. We could say we're going to do an after action review. We're going to basically pull the snapshot from Voyager. We have all the information. We're going to go through it and say, what did we miss? Right? What was the thing that we should have looked at and understood about this business? And then how can we improve in the future? And that might inform all kinds of stuff. It might inform like a data point we track that we didn't track in the past. It might inform a new founder paradigm. It might inform just, hey, we got to be more of a prepared mind in a certain category. So that's kind of how we use it. And, it's a different approach. It does require it requires you to think a bit differently. And I
Yes.
think we have to, when we're hiring people, we got to figure out like, who wants to think this way? Because certain people don't. Certain people are like, no, I just want to think about investing the traditional way, and it's kind of gut feel, and it's my network, and that model works. But it's different from our model. So,
Well, or the growth model where, people might be better at numbers and spreadsheets and metrics and mental math. And now you're optimizing more for subjective insight. And, It's funny because we have a very similar framework where we rank 6 different characteristics on a 50th to 99th percentile scale, and we've very specifically defined the differences. So,
what are some of the characteristics you guys look at?
Yes, they're tenacity, resourcefulness, obsession, learning appetite, magnetism, and I'm forgetting one.
I like this. I like learning appetite especially. I think that's a great one. Magnetism. That's kind of interesting. Yeah, those are great.
Yeah, and some have some, and not others. But it's, not every founder is the same. They're all unique snowflakes.
Yeah, you're right. And it's also like you learn a lot. Like you can try to like assess the founder and their mental makeup. I think it's easier for like repeat founders where there's a lot of data. But I have found that like especially for first time founders, there's just certain things you're not going to know. You're not going to know how somebody performs in situations. You're not going to know if this person wants to sell the business when they get an offer for 50 million versus building it for another 10 years and trying to get it to $1 billion. It's just certain things you're not going to know. So you just have to like make the best assessment you can. You learn as you're going, and I think that will inform the follow on and, all the decisions you make subsequent to that. But there's just certain things that are just unknowns. And, I'm sure a founder would say the same thing about, us as investors or any investor, they don't know how you're going to react, to certain elements. So there's an element of like of uncertainty, and I think that's maybe part of the magic of investing is you just certain things you're just not going to know, and that's part of the fun of the game, and it gives you the surprises, positive and negative.
Well, I apologize for the tangents.
That's
we're probably not going to get to all the meaty business stuff, but maybe I'll throw it to you. Like, I know you invest around themes.
Yes.
I know there's a lot of emphasis in, various vertical SaaS, fintech.
Yes.
You've written about AI.
Yes.
And I've enjoyed kind of reading, all the content coming out, but give us kind of some thoughts on like thematic areas of interest and how you see AI playing a role kind of in the next, 3 to 5 years of investing.
Definitely. So I'll maybe describe like how we come up with our themes and then how we apply them over time. And then to your point, like how AI plays a role. So, and this has been an aspect of the firm's evolution as we've grown, so we started off as Aaron and I kind of as investors, we were investing across a broad set of areas within software. We've always been software investors. We love software companies, obvious reasons, high gross margins, capital efficient. You can invest relatively small amount of money in the early days and kind of prove it out. And so we like those elements of software companies. Many people do. But as we grew, we really kind of built out a set of thematic areas. We do a lot of vertical SaaS. We love vertical SaaS for a lot of reasons. Some of those markets can kind of fit in that kind of like overlooked, kind of like sneaky big. There's a lot of stickiness in vertical SaaS. Usually there's this kind of like evolution of vertical SaaS companies. And I think now you're seeing, and we'll talk about this with AI, like this idea of like you had SaaS 1.0, which is kind of like old school, like actually maybe 1.0 was basically client server way back when. And then, 2.0 was SaaS. And now you got 3.0 with AI. We find within vertical SaaS is like some of these markets, one, they can be a lot larger than you think. And two, if you're the winner, it can be quite lucrative, but you kind of have to find the number one or maybe the number two. There's not like 5 winners. We do a lot of vertical SaaS. Fintech is an area we've been increasingly active in. We're believers in fintech for a lot of reasons. And we can kind of talk about this, but combination of like the pure sheer size of the TAMs, the fact that there's still a lot of inefficiency in terms of financial services, a lot of technology waves that are kind of like bearing fruit now. So we do a lot of fintech, both consumer as well as B2B fintech. We will do some consumer. Aaron really leads our consumer investing. Interestingly, although a smaller number of our deals have been consumer, some of our biggest wins have been consumer. So I mentioned Resident as an example. We have other companies like Goldbelly, Overtime that have gotten to quite large revenue size. So we'll do consumer. We typically look for a lot of capital efficiency, usually kind of post-revenue where we have early evidence of consumer demand and adoption. We'll sometimes do pre-launch consumer, but it's pretty selective, there. A couple other areas we'll do dev tools and infrastructure software. That's an area that requires more technical depth, but we will invest there. We're kind of growing out that practice. And we do a smaller amount of deep tech, and that area is really led by Vardhan Gatani, my colleague. But we'll do some deep tech as well. So AI. Okay. So that's a really in-depth, and we can kind of go very depth if we want, but so we think about AI in a couple different ways. The first is we think a lot about business model changes with AI. And I think this is actually an area that's maybe been understudied by VCs. So I think if you think about AI today, there's been pretty dramatic adoption of consumer AI as well as AI within businesses, right? You have companies that will go from 0 to 20 million revenues or what have you, or even more. Some companies grow even faster. So there's this really rapid early adoption cycle, right? Now, at the same time, you have oftentimes in some of these categories a lot of competition. And I think the jury is sometimes out around things like revenue retention, defensibility of the product, whether the long-term economics are really attractive. We do know that, AI can potentially drive down costs in a lot of ways. But if you think about like the cost to train a model, the cost to deploy it, and then like the staying power of that, I think the jury's still out on some of those elements. And so for AI, like we think about a couple areas. The first is like, what are areas where we think there's like staying power, defensibility, and in some moat in terms of the business. So we've done a lot of, for example, vertical SaaS areas that are a little bit off the beaten path, where we feel like, hey, there's not going to be 50 founders going after this. And also the founders that do pursue it, they have to have some level of domain expertise and understanding. So I'll mention one. We did a deal, my colleague John, a deal in a company called Informed. Informed is software for clinical pharmacy. The founder of that business has a PhD in pharmacy. He spent a long time thinking about how to provide a data service to pharmacists that was better than what existed. And that process, that kind of earned secret, led him to AI as kind of a deployment mechanism for that. But he wasn't starting the business saying, I want to build an AI company. He was basically saying, let me solve this problem within pharmacy. And he came upon AI as the best solution. We like that actually a bit better than saying, hey, I need to, apply AI to a certain area, right? I think it's better to say, I deeply understand a problem and I'm going to use AI to solve it because I think it's the best way.
It's the best tool. So what was the data issue for pharmacists? Why do they need access to data?
So long story short, in that area, you have a lot of kind of old databases where the information is not really surfaced in a way that can be actionable for the pharmacist. He also wanted to enable the pharmacist to ask questions kind of in natural language. So if you're a pharmacist that's trying to figure out like, what product should I add to my formulary, or in a new area, say, of medicine, like how advanced is it, and are these drugs ready for prime time, what have you. Like, you want to be able to do research there, but you also want to like use natural language to query. You want to be able to customize your queries, have those queries be responded to in a fast period of time. And that didn't really exist. And so that's what Ashish, the founder of InFarm, started to kind of think a lot about. And that kind of led him on his process of starting and really building that business. So there's examples like that. I'll mention one example. So I'm on the board of a company called Reflex AI. Reflex AI basically provides software for training and for quality assurance within call centers. The founders of Reflex AI, Sam and John, had been actually working at a nonprofit that basically effectively was a nonprofit focused on mental health. And basically they ran a call center responding to individuals who were having challenges. And within that environment, they started to say, hey, how do we train our call center operators better? How do we make sure they're prepared for these really high stakes conversations? And so they said, look, let's think about how to simulate conversations and also how to track the quality of conversations that folks are having. And from that became the early kind of germ of an idea that became Reflex AI, which basically today is AI software to enable training and in simulations and then quality assurance within call centers. And they started off focusing on high stakes call centers. So similar to the company they had worked at, but now they're seeing opportunities in a pretty broad range of verticals. And what's interesting about that one is the insights that they had for these very high stakes kind of like really life or death conversations can be applicable to other areas. And if you can kind of get it right in those high stakes conversations, you can apply it to a lot of different engagements, right? A lot of different areas of call centers where the stakes aren't nearly as high, I guess I would say, right? So that's an example of a founding team that, again, was addressing a problem they had using AI, then said, look, we can build a standalone company based on these learnings. But it was kind of an iterative process. So we like that a lot. We really like this idea of founders kind of almost on a quest to solve a problem rather than a founding team saying, hey, like I'm trying to find a problem to solve.
Yep. It's like when you're a hammer, everything looks like a nail. Like, here's the tool I know.
Yeah.
Now what should I go do with it, right?
And the other thing is, this is what I've learned, it's a little bit of a test around how much you care about it. Because, if you're looking for a problem to solve, if everything goes well at the beginning, you might stick with it, right? But that's more of a mercenary approach. The missionary approach is like, I care about this problem. And so even if it doesn't go well at the beginning, even if it takes me years to figure this thing out, even if it's, like I'm slogging along, I'm going to do this because I care about it, right?
That's right.
It's a signal that they're going to stay the course. And that's super important. Like one thing we found in our portfolio is like many of the best companies, like they don't often look great in the beginning. There's a lot that's kind of moving and like you're not really sure, but if they're willing to kind of slog it out and go through those tough times because they care about solving a problem, like that is really valuable. Like that can really enable a founding team to figure something out that other folks cannot figure out just because they spent the time because they cared enough to really solve that problem.
100%. I mean, the only guarantee is there's going to be high highs and low lows, and you've got to really care to survive the roller coaster.
That's very true.
All right, just a few wrap-up questions here. Nnamdi, I noticed you recently opened an office in the Bay Area.
Yeah.
Would love to hear your thoughts on the future of, 645 and what it looks like in 5 years.
Yes. So we did open up that office. We've been growing it. We opened it up for a couple of reasons. One, because many of our best early wins were Bay Area companies like Resident or Iterable, which is now over 200 million in revenues. We felt as we were stepping up from co-investing to leading rounds, it'd be really important for us to have a presence there. So we opened up the office. We're growing it. We're actually looking for a senior investor, a partner investor in that office. So if folks are interested, they should definitely drop me a note. But it's part of our strategy. We do invest across geographies. That's important to note. But we have found that a lot of our best businesses are in that general area, especially given now the growth of AI. So it is part of our strategy, and that's why we expanded there.
Nnamdi, if we could feature anyone here on the show, who do you think we should interview, and what topic would you like to hear them speak about?
Yeah. There's a couple folks that I think it'd be great to profile. I'm not sure if you've had these folks yet, but Scott Birnbaum, who started a firm called Ratchet Ventures here in New York, He's got a great story, really compelling, really interesting approach to investing in consumer. He'd be somebody I'd highly recommend. Anu Dugal from Female Founders Fund. I'm not sure if she's joined you in the past. She's built a great firm. She's had some great wins. She's built a pretty amazing community. I think she'd also have a great perspective on how to take a pain point that she identified in terms of a lack of capital going to great female founders and how she built a firm around solving that problem. And she's done that really effectively.
If you could recommend a book, article, or video to listeners, what would you recommend?
Pattern Breakers by Mike Maples. I think it's one of the best books about investing in exceptional companies, but also like what it takes to build an exceptional company. I think Mike's amazing, but I think the book just has some great insights that I think are super valuable.
Absolute gem. We just had Mike on the show a few weeks ago.
Yeah. It's great.
And then finally here, Nnamdi, what's the best way for listeners to connect with you and follow along with the firm?
Yeah, definitely. Well, a bunch of ways. You can definitely connect with me on LinkedIn. You can send me an email. It's just my first name, Nnamdi at 645ventures.com. I try to be pretty responsive to emails, but I'd say LinkedIn or email is probably the best.
Well, huge congrats to you, sir, for the success. There's many firms that are started, but there are not many that make it to Fund 4 and have the winners that 645 does. So thanks so much for joining us and appreciate all the insights today.
It's a pleasure, Nick. Thanks for having me. I really enjoyed it. Thank you.
Thanks, Nnamdi.